Hello, everyone, and welcome. Have you ever seen a company release its big earnings report and wondered what happens next? Well, let me tell you, it's so much more than just a bunch of numbers on a page. Today, we are going to pull back that curtain on accounting and find out who is actually using this information and, maybe more importantly, what kind of critical decisions they're making with it.
All right, let's just jump right in with a little thought experiment. Imagine a company announces a record-breaking profit. Your first thought is probably, wow, they must be crushing it. But is that the whole story? I mean, what if that profit came from, I don't know, cutting corners on quality? Or what if the company is sitting on a mountain of debt that's about to come due? See, that one single profit number, it doesn't even begin to tell the whole story. And that is exactly why we need to dig a little deeper and really understand who is looking at these numbers and the kinds of tough questions they're asking. So here's our game plan for today. We'll kick things off by framing accounting's real purpose. Then we're going to meet the two main groups of users, the folks inside the company, the internal decision makers, and then everyone on the outside, our external stakeholders. And finally, we'll wrap it all up by seeing how accounting really is the universal language of business. Okay, let's get into it. First things first, we need to shift our mindset. You know, a lot of people hear the word accounting and they immediately think of these complicated spreadsheets and just numbers. But I want you to start thinking about it in a totally different way. Think of it as the story a company is telling about itself. And today, we're going to learn how to read that story. This report card analogy, it's pretty much perfect. A company's financial statements, that's its report card. You've got the income statement, which tells you how it performed over the last quarter or year. Then there's the balance sheet, which is like a snapshot of its financial health on one specific day. And the cash flow statement, that shows you exactly where the money came from and where it went. And just like a real report card from school, different people are going to flip right to different subjects. So let's meet the people who are reading this thing. Okay, our first group, these are the insiders. These are the people on the front lines, the ones inside the company who are using this information every single day to make choices, and really to steer the ship. This is the world of what we call managerial accounting, where all the data is specifically tailored for people inside the company.
And who's at the helm of that ship? Well, first and foremost, you've got the managers. They are the ones responsible for making those day-to-day calls and those big-picture strategic choices that will literally shape the company's future.
You know, what's really fascinating here is just how wide-ranging a manager's use of this information is. They are constantly asking questions. Things like, hey, are we on budget for this quarter? That's planning. Or why are our production costs suddenly so much higher than we expected? That's control. Or the big one, should we build a whole new factory? That's a massive strategic decision. And which of our product lines is actually the most profitable? That's all about performance evaluation. Every single one of these questions is answered using detailed internal accounting data.
Now, here's a really common mistake that students make. They think managers only care about that bottom line profit number. But in reality, they are way deeper in the weeds. They're asking tough operational questions just like this one. They're poring over specific cost reports, they're analyzing profit margins, and they're trying to figure out where to put the company's money. And this isn't just theory from a textbook. This is a real, live conversation happening in conference rooms all over the world, every single day.
Now let's talk about another really crucial internal group. This is one that sometimes gets overlooked, but they have a deeply personal stake in the company's numbers, the employees themselves.
I mean, think about it. For an employee, the stakes are incredibly personal, right? The company's financial health isn't some abstract idea. It directly hits their wallet and their future. They're asking, is this company stable enough that I'll have a job next year? Can it actually afford to fund our retirement plan? Are things like pay raises or bonuses even a remote possibility this year? The financial statements help them find answers to all of this.
This quote right here is a perfect illustration of the employee's point of view. They're not just looking at this year's profit. No, they're thinking about their future, 10, 20, 30 years down the line. We've all seen those terrible news stories about companies that look great on the surface, but had pension plans that were severely underfunded. So employees are using this information to protect themselves and to really gauge the long-term health of their employer.
So, we've seen how people inside the company use this super detailed, up-to-the-minute data to actually run the business. But what about everybody else? What about all the people outside the company walls who are also making huge decisions about it? Well, that brings us to our second major group, the external stakeholders. And as you'll see, their perspective and the kind of information they get is completely different. All right, this next group is so interesting because they're making these massive financial commitments based on publicly available info, like the company's annual report. This is the world of financial accounting, where all the information is standardized so the public can understand it. These folks are putting their own money or their clients' money right on the line.
So who's the most obvious external user, the one we hear about all the time on the news? It's the investor. These are the individuals, the big institutions, who are putting their own capital at risk, all in the hope of getting a return on that investment.
In a way, an investor is kind of like a fortune teller, trying to use the past to predict the future. They pore over those financial statements, looking for trends, calculating all sorts of key ratios. For instance, they might look at something like earnings per share, or EPS, to see how profitable the company is for every single share of stock out there. And based on all that analysis, they make that huge decision. Do I buy, do I sell, or do I just hold on?
And just stop and think about the gravity of a question like this one. An investment manager isn't just rolling the dice. They have what's called a fiduciary duty to their clients. They have to act in their best interest. They're constantly weighing the potential risk against the potential reward, and every single number on that financial statement is a critical piece of evidence in their case.
Okay, next up, we have another major external player, the creditors and the lenders. Now, this could be a bank, it could be people who buy the company's bonds, or even just suppliers who let them buy goods on credit. Their job is to decide if the company is a good bet to pay back a loan.
Now, this is a really key distinction. Unlike an investor who gets to share in the profits if the company does great, a creditor's potential upside is capped. All they want is to get their original money back plus some interest. That's it. So because of that, they prioritize things like stability, solvency, and cash flow way more than anything else.
See, a creditor is asking a fundamentally different question. They're not daydreaming about the company's explosive growth potential. They're worried about downside risk. They're going to look at things like the debt-to-equity ratio to see just how much debt the company's carrying compared to its equity. If that ratio is too high, it's a huge red flag. For them, it is all about safety and predictability.
And finally, let's not forget about the government. You've got agencies like the IRS or the SEC, and they use accounting information all the time. But their goal isn't profit or investment returns. Their goal is simply compliance. They need to make sure the company is paying its fair share of taxes and that it's following all the specific rules and regulations for its industry. So we've met all these different players, right? Managers, employees, investors, creditors, regulators. They all have totally different goals and motivations. So what's the one crucial thing that ties them all together?
Well, the answer is right here. Accounting is the common language that every single one of them speaks. It doesn't matter if you're a CEO in New York or an investor in Tokyo. You're looking at financial statements that were prepared using a standardized set of rules, like GAAP here in the US or IFRS for much of the rest of the world. This common language is what makes global business even possible. It reduces uncertainty and lets everyone, everywhere, make informed, rational decisions.
So I'll just leave you with this final thought. As you go deeper into your business studies, start thinking about which of these hats you might wear one day. Are you going to be the manager, using data to steer the ship, or the investor, hunting for that next big opportunity? Maybe the creditor, whose job is to ensure stability. Understanding these very distinct perspectives is the absolute first, most critical step toward mastering the art and the science of business decision-making.